Welcome back to FX Limit, the go-to channel for all things Forex trading. Today, we're diving deep into a crucial topic that every trader needs to understand, inflation, and its role in fundamental analysis for Forex trading. By the end of this video, you'll have a clear understanding of how inflation impacts currency values and how you can analyze its effects to make more informed trading decisions. So, what is inflation? In simple terms, inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. But how does this relate to Forex trading? Well, inflation is a key economic indicator, and it plays a significant role in a country's monetary policy and currency value. When inflation is high, the value of a currency tends to decrease. This is because the purchasing power of a unit of currency is eroded as prices rise. On the other hand, when inflation is low or negative, deflation, the value of a currency may increase. This is because each unit of currency can buy more goods and services when prices are falling. Now, let's talk about how you can analyze the impact of inflation on currency values. The first step is to keep an eye on inflation rates. Most countries release inflation data on a monthly basis, and this information is readily available on economic calendars and financial news websites. Pay attention to whether inflation is rising or falling, and how it compares to the country's inflation target. Central banks typically have an inflation target, often around 2%, and they will adjust monetary policy to try to achieve this target. Interest rates are another key factor to consider. Central banks may raise interest rates to combat high inflation, as this makes borrowing more expensive and encourages saving, which can help to reduce inflationary pressures. Conversely, they may lower interest rates to stimulate spending and investment when inflation is low. These interest rate decisions have a direct impact on currency values. Currencies from countries with higher interest rates tend to attract more foreign capital, driving up their value. On the other hand, currencies from countries with lower interest rates tend to be less attractive to foreign investors, leading to a decrease in value. Another aspect to consider is inflation differentials between countries. If a country's inflation rate is higher than that of its trading partners, its goods and services become less competitive, leading to a decrease in demand for its currency. Conversely, if a country's inflation rate is lower than that of its trading partners, its goods and services become more competitive, leading to an increase in demand for its currency. To sum it up, inflation is a key economic indicator that plays a significant role in fundamental analysis for Forex trading. High inflation tends to lead to a decrease in currency value, while low inflation can lead to an increase in currency value. Interest rates and inflation differentials between countries are also important factors to consider. By keeping an eye on these factors and understanding how they interact, you can make more informed trading decisions and potentially increase your chances of success in the Forex market. That's it for today's video. I hope you now have a better understanding of the role of inflation in Forex trading and how to analyze its impact on currency values. If you found this video helpful, make sure to hit the like button, subscribe to FX Limit, and turn on notifications so you don't miss any of our future trading tips and insights. And as always, if you have any questions or topics you'd like us to cover in future videos, feel free to leave a comment below. Happy trading, and see you in the next video.